Earlier this week, the Walt Disney Company filed a new Form 8K with the United States Securities and Exchange Commission. Basically, what they're doing now is restructuring the way that they report their revenues to the public in their quarterly earnings calls. The next one, of course, is on November 8th. So if you were like one of the nearly 8,000 folks that joined us live here on Valiant Renegade for the last quarterly earnings call for the Walt Disney Company in August, then you best pay attention to this video because you're going to want to have this information before going into the one on November 8th because there are a lot of changes here. We're seeing new data that we've never seen before. Things like ESPN and the sports segment at Disney broken out as its own separate line item and the revenues and costs associated with it. Linear networks are now their own separate item, and direct-to-consumer is just Hulu and Disney Plus. No more ESPN Plus reported in there. And now, for the first time ever, Disney is actually showing us what theatrical distribution revenue is as a separate line item. This one is a doozy, folks. Stay tuned. We're going to break it down for you right now. Here we go. Renegade Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see everybody out there once again. And if you are like one of the many folks watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Make sure to join us every Sunday afternoon at 6 p.m. Eastern right here on Valiant Renegade for the live show. Let's dive straight in. This is the latest 8K from the Walt Disney Company filed on October 18th, 2023, just 2 days ago, as you're watching this video on its premiere day, that Bob Iger and company guided forward. This was something that was coming. We knew this was going to happen. We've been waiting for this. We knew it was going to have to happen. Before the November 8th earnings call, it was just a matter of time because, as Disney has previously discussed in the last one or two earnings calls, they were going to be reorganizing how they reported their financial data moving forward. And part of the reasoning behind this is because Disney wanted to segregate certain things like the sports-only section for Disney. That'd be ESPN. And now ESPN Plus, the direct-to-consumer service, is going to be included in their sports and ESPN reporting. No longer is ESPN Plus going to be lumped in blindly with things like Hulu and Disney Plus. We're now going to see that pulled out. Big changes there. We're also going to see things like theatrical distribution pulled out as its own line item, like I talked about in the intro. So all of that has to be done ahead of time before this next quarterly earnings call. And the reason for that is in order to have relevant comparative metrics, in order to have the data align with the new earnings call that we will get on November 8th, for the quarter that ended on September 30th, just about 3 weeks ago, Disney has to go back to the previous 3 quarters. And then what they also did was the entirety of fiscal year 2022 was to realign all of the financial reporting, all of it for the last, say, 24 months in order for those numbers to match up with what they're about to report on November 8th so that people can have a comparison between the end of the 2023 fiscal year and the end of the 2022 fiscal year, the end of all of the quarters in 2023 versus all the quarters in 2022. If Disney had merely left the financial reports stand as they were, there'd be no way for Wall Street to really decipher, well, how well did this segment actually perform compared to last year, since last year's numbers were reported in a completely different fashion. That is what this 8K is intended to do. And I want to stress more than anything, there is no new financial reporting here. This is merely a restatement of financial reporting that has come over the past 2 years, roughly, and just broken out in a different fashion to match up to new data. Let's read from the Topline highlights. Media and entertainment reorganization. In February 2023, the company announced that to restore creativity to the center of our business, we're going to reorganize our media and entertainment business, which had been previously reported in one segment, which was DMED. You've heard us say that before, Disney Media and Entertainment Division. As a result, effective with the fourth quarter of fiscal 2023, that's the quarter that's going to be reported on November 8th. I'll remind folks again, Disney's fiscal reporting year runs from October 1st through September 30th of the following year. It does not follow the calendar year. So what we're going to get on November 8th is the fourth fiscal quarter and the end-of-year results for the Walt Disney Company for fiscal 23. Media and entertainment business will be reported in two segments from now on. Entertainment and sports completely separated out, thereby providing increased transparency by giving incremental detail on our linear networks and sports business. Consumer products and revenue share. Under the new segment of financial reporting, the entertainment segment will receive an inter-segment allocation of revenues, meaning that the entertainment segment is going to see a portion of revenues from consumer products and revenue and licensing, provided that they actually tie to things like the Disney films themselves versus all of the licensing being housed under one banner. This revenue allocation, which is now consistent with the approach taken prior to our last segment reporting, is meant to reflect royalties on merchandise licensing revenues generated on intellectual property, or IP, created by the entertainment segment, more consistent with certain of our industry peers and reflective of the value that this IP brings to our consumer products business. So put simply, Disney is now going to be reporting certain intellectual property content licensing under the entertainment division still, while others might still be under parks and experiences, for example. And that all depends on where the merchandise is sold and what the merchandise is tied to. So, for example, if the Walt Disney Company licenses out the character of Elsa and Anna from Frozen, then they are going to tie those licensing revenues for any merchandise or products created from that IP, that intellectual property, back to the entertainment division. Let's focus in on the new entertainment division because a lot of changes have occurred here. There are three subsections going forward with how Disney is going to report, according to them, in order to offer a lot more transparency. Sports has been removed now, and that's the big thing. Sports and ESPN will no longer be reported under this entertainment division. Neither will ESPN Plus on DTC. According to Disney, linear networks will include, moving forward and for the restructured reporting for the past 12 months, ABC Television Network, Disney Channel, Freeform, FX, and Nat Geo, which is owned 73% by the Disney Company, branded television channels, and 8 owned ABC affiliate television stations. On the international side, Disney Channel again, Fox, FX, Nat Geo, and Star. And then you've got a 50% equity investment in A&E Television Networks, which operates cable channels including A&E, History, and Lifetime. Direct-to-consumer. This is a big change, folks. DTC, direct-to-consumer, includes the following services. Disney Plus, including Star in Latin America. And then Hulu, which currently is still standing at a 67% ownership by the Walt Disney Company, soon to be 100% as soon as they close the deal with Comcast in the next several weeks ahead. And then Disney Plus Hotstar will be broken out from Disney Plus. That is the Disney Plus system that exists in India. That includes general entertainment and sports programming. And then finally, content sales and licensing, the subcategories of which are the sale and licensing of film and television content to third-party television and subscription, advertising, video on demand, or SVOD services, theatrical distribution. Yes, you're about to see for the first time ever Disney breaking out in recent history theatrical distribution revenues on their earnings report. We're going to show you that in just a moment. Staging and licensing of live entertainment like Broadway. Think of Lion King. Home entertainment distribution of DVD and Blu-ray sales, electronic home video licenses, and video on-demand rentals. And as we mentioned before, inter-segment allocation of revenues from the experiences segment, which is meant to reflect the royalties on consumer products like those Elsa and Anna dolls from Frozen, for example, on consumer products merchandise, licensing revenues generated on IPs created by the entertainment segment. In other words, the movies and television shows, you can throw things like Baby Yoda Grogu in there and Mandoverse and all that kind of stuff. One of the few things that still sells for Disney on their brand of Star Wars, that is going to be reported under that content sales and licensing. And then, of course, Disney's music distribution library. And then, interestingly enough, now we will also have post-production services by Industrial Lights and Magic and Skywalker Sound. So that's not just going to be housed under, say, Lucasfilm anymore. Disney's actually going to be reporting those post-production services from ILM and Skywalker Sound to Lucasfilm Acquisitions under content sales and licensing as its own separate piece. So effectively, what we get from Disney going forward and in the restated reports is one segment dedicated to nothing but television and movies. That's the entertainment division and the licensing revenues for the IPs that go along with it. We'll have a second segment that is nothing but sports. That would be linear broadcast and direct-to-consumer content related to ESPN and ABC Sports, and a third segment that is nothing but parks and hotels. So to give you a rough idea of how some of these changes on the reporting is going to impact the financials, let's take a look right here. If we look at this chart, this is Disney's as originally reported, as you see in the leftmost column. The revenues attributed to these various segments as Disney previously had reported them. Linear networks at $20.6 billion. And if you look just to the right, you'll see a negative $11.535 billion from that figure. That's due to the reorganization. Again, in direct-to-consumer, $16.3 billion. You see a negative $1.496 billion just to the right of that under reorganization, for a total of $13.031 billion that has been removed from the entertainment division. And then just below that negative 13.031, you see a positive 13.031 entry. That's a dollar for dollar move over to, look at the left side again, sports. They're under entertainment. So in other words, the total revenue for the sports broadcasts or direct-to-consumer on ESPN Plus for the Walt Disney Company during this period was $13 billion worth. So in other words, for the 9 months ended in the fiscal year of 2023 for Disney, that'd be through June 30th of 2023, beginning October 1st of last year, 2022, of the total $42.8 billion that was previously reported in the entertainment side of things in gross revenues, $13.031 billion of that has been removed and then shuffled over to sports in the reorganization. So now we're starting to see how much of that total revenue picture for the Disney company was just coming from sports, now being reported in its own line item. But more specifically, in the broken down segments, let's take a look underneath the entertainment headline banner to linear, DTC, and content sales and licensing. This is the reorganization. Previously, linear networks reported a total, including sports, of $4.972 billion for the 9 months ended on June 30th. Direct-to-consumer, DTC, which would have previously included Disney Plus, Hulu, and ESPN Plus, all subscription services, a loss of $2.224 billion, and content sales and licensing, a loss of $505 billion. What is being reorganized and shuffled about from entertainment out of that previous reporting now to the new sports division? It's $1.484 billion. So, in other words, sports at $1.484 billion is obviously making Disney money. If you look all the way over to the right where I've got it highlighted, $3.314 billion in operating income for linear networks previously under the old reporting system, a loss of $2 billion on streaming in total. Look now at the restated figures of operating income for these divisions. $1.208 billion for fiscal year to date through 3 quarters in entertainment, $1.484 billion in sports, and $7.195 billion in parks and experiences. Let's take a look at one level deeper. When it comes to revenues and operating incomes or losses under the entertainment division, these are the new recast, as they call them, or the restructured financial reporting. Take a look for yourself. Direct to consumer, right here. Now, as a reminder, this no longer includes ESPN Plus. This is strictly Hulu and Disney Plus. And Hulu, by all accounts, as far as we're aware, is a fairly profitable endeavor for Disney and Comcast, less there would not be such a fight over what the value of this product is when Comcast is trying to sell the rest of it over to Disney. Look at DTC. The total 9-month gross revenue between Hulu and Disney Plus, minus ESPN Plus now, $14.8 billion. And if we look down to direct-to-consumer under operating income or loss, they had a loss of $2.076 billion. What that seems to show, once again, is that the largesse of the losses are being absolutely unequivocally racked up by Disney+. Hulu is not seemingly contributing to these losses, nor is ESPN Plus, which has now been removed from DTC's reporting and placed into sports. That didn't change the loss figures on DTC very much at all when they pulled ESPN out. And that means that Disney is still spending way too much money producing content and advertising for Disney+, especially when given the mediocre results of the viewership habits for most folks that are still watching Disney+. But now we get to see some real breakdowns here. Basically, what we're looking at is affiliate fees from, say, cable providers and satellite TV providers, also the affiliate fees that Disney receives from ABC affiliate networks around the country. We see that under linear networks. We see direct-to-consumer, that is the fees and subscription fees that they receive from folks that subscribe to Disney Plus and Hulu in this case. So linear networks are showing 9 months ended July 1st, 2023, $9 billion. Direct-to-consumer subscription fees coming from Hulu and Disney Plus totaling $14.85 billion. Linear networks showing an operating income or a relative metric of profit, $3.314 billion, and a loss of $2.076 billion on direct-to-consumer. Again, I remind folks, this is now having sports, live sports, netted out of how they previously reported these figures. This is purely Disney television. But let's look to see how big and bad Disney Plus and Hulu really are. Now, again, I wish that Disney Plus and Hulu were broken out separately, but they're not. So we're going to go with what we've got here. Maybe one day that will happen. I think it very well could after Disney acquires the remainder share from Comcast in the next few weeks and months. But let's look at direct-to-consumer. Again, Disney Plus and Hulu only, $12.243 billion. Advertising revenue between Hulu and Disney Plus. Of course, mostly this is from Hulu, $2.4 billion. Take a look at the operating expenses here, $13.6 billion. That's what Disney is spending to produce the content that is on these services right now. Selling, general, and administrative, or SGA, about $3 billion. That's what they're spending to advertise and promote the shows and services that they're trying to get people to watch. That's where the $2 billion in loss comes in for direct-to-consumer. And now, finally, we get a further breakdown. TV and streaming video-on-demand distribution, $2 billion for the 9 months into July 1st. Theatrical distribution, this is the first time we've seen this, $2.745 billion in, this is, again, gross revenue for theatrical distribution. We'll talk about that in just a minute. That's not what they made. That's what they brought in the gross before they took out their expenses. Home entertainment distribution, again, premium video on demand sales and rentals. Then physical media sales, for example, and any licensing from that, $639 million. Now look down here at the operating expenses that you can see right here. That is the cost of production for the material that they are putting onto television and into movie theaters. They have a total of a $5 billion spend on those operating expenses. Now, of course, this includes some few other items in that regard as well. Things like actually producing the physical media itself. But you can tell by the physical media sales, we're talking about a drop in the bucket by compared to what they're spending to actually make television shows and movies. Selling, general, administrative, and other. And that's probably mostly selling. That $2 billion loss here is mostly from, say, advertising films that were released in theater or advertising things that were being released on Disney+. Think of the movies that Disney had this year. In terms of the revenue side of things, they had 3 months or so worth of Avatar following its release at the end of 2022. So the revenues that Avatar: The Way of Water generated from January 1st to March 31st, well, that's going to be included in that quarter ended April 1st, 2023. That's why we see theatrical distribution revenues up there around $767 million where my cursor is floating. By July 1st, 2023, they had other movies come out. For example, things like Little Mermaid, Ant-Man and the Wasp: Quantumania, Guardians of the Galaxy Volume 3, and really one day of Indiana Jones and the Dial of Destiny. That brought in $838 million from the box office. But look at the operating expenses beneath there. we're talking about major expenditures, not only on those films that generated that theatrical distribution revenue, but the home entertainment distribution, the TV and SVOD distribution as well. They're just spending more than they're taking in to produce these massively expensive IPs, as we've been reporting, and this confirms it. Look at what they're spending on selling and general and administrative. That is, for example, one of the biggest components there, the marketing costs of major theatrical releases. All the movies that I just listed off there. $722 million loss in SG&A, meaning that's what they spent in December 30th, the quarter ending December 31st, 2022. They spent another $550 million, a little over $500 million by the quarter that ended on April 1st, 23. $752 million, almost $750 million spent in advertising Disney movies and TV shows in the quarter that ended on June 30th of this year. And then look here at operating income or loss. You can see these numbers are in the negative. That's what the brackets mean. They lost about $112 million total in the quarter that ended when several Disney movies came out. $30 million total so far for the fiscal year through the first 9 months as of June 30th. Now, again, I want to remind folks, those losses are not all just related to theatrical distribution. There's a lot of things propping them up, like home entertainment distribution and TV and SVOD distribution. So that is still masking some of the problems they're having at the theater. But obviously, if theatrical performance for Disney films was much more robust, if it was much more like what they enjoyed in the years from, say, 2010 to 2019, these numbers would not be negative. They'd be positive into the hundreds of millions of dollars. That's where Disney is really losing. There is a lot more detail in these reports, more so that we can go through really in a single video, short of it being several hours long. But we are going to talk about this more in depth on the Sunday live show to give you all the information that you need to be armed with, to be more informed and well-educated heading into the November 8th earnings call for the Walt Disney Company that, of course, again, we will be covering live right here on Valiant Renegade. Stay tuned for that. We hope to see you Sunday afternoon, 6 p.m. Eastern Standard Time. And until then, take care. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.